Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
All right, we're back here. Investor Coaching Show. Paul Winkler. I should put you on camera. I should have just done it. Okay, so would you trust AI to help you invest your money, manage your portfolios? Nearly 50% of adults in this one survey said that they were obtaining stock market guidance through this. Problem with this, of course, is that where you're getting your information. The idea, if you're trying to get which stock is going to do better than others, which area of the market's going to do better than others, you're actually responding after information is already built into stocks. How do we know that? Is because of investor performance when they're managing a portfolio in that particular manner versus they're holding a market segment. You know, if you look at it, it's abysmal. It's most of the time, the market does better than the investor trying to engage in that. So this whole thing that I was talking about just before the break was a study or a news segment, done, where they were actually talking to these people that said, hey, we're going to start off this new investment firm and we're going to this market maker. We're going to make markets for stocks, but we will not allow computerized trading on our platform because computerized trading is horrible and it's awful for investors and mutual fund companies don't like it and all that stuff. So what happens is they come back and they say, this is what we're going to do. And because the news media is covering this, there's demand for what these people are doing. Well, I did a video and I'm talking about this going, wait. Let me explain something here. And here's what they're talking about is you have people front running, so to speak, and they're buying up stock before you can buy it. The computers are buying it before you can buy it, and they're marketing it up and selling it to you, and they're taking you to the cleaners, is what they basically said in the news segment. And I said, let me explain it this way. So you got these different market makers. You know, market maker A, and let's just say market maker B, and this just ended at that. They're just two entities that hold an inventory in a particular stock. So you see a trade. The computer sees a trade. And that trade, let's say that market maker A holds 8 shares of the stock, and that's all they hold is that. I'm going to make this ridiculously simple. And then market maker B holds 8 shares of that stock as well. So somebody comes in and buys up all of the inventory of A because they're the cheapest supplier of the stock. So what happens is somebody buys up the whole inventory. They got 8 shares. The computer sees this thing and goes, whoa, let's buy up B's inventory of stock, and then we'll mark it up and we'll sell it to this person that seems to be really hot on this stock and they really want to buy it. Mm-hmm. But what happens is the person buying only bought 10 shares. You know, so in my example, so they bought up all 8 of A's shares that they had, and they bought only 2 of the 8 that B had in the inventory. So hence what happens here is now you have the computer bought the other 6 shares too. They bought all of it. They bought all those 8 shares, let's say, thinking that they were going to buy up all of that, and then they don't have a buyer for the other 6 shares in my example. So they get hosed. They basically don't have a buyer. They marked it up, but that wasn't the market price for the security, that higher price. It was only the price that person was willing to pay if they bought all 16 shares. So what happens is that you look at this and go, well, sometimes they win, sometimes they lose. The computers do. Yeah. And the example that I used as well was there was a story about in Upper Manhattan where there was a buyer of shares. And you have somebody that wants to buy shares. And what happened is that you have computers down in Lower Manhattan near Wall Street. And you would have people that would hollow out. And somebody up on, right, remember this?
Oh, yeah.
Up on Upper Manhattan, you have computers that buy those shares, and somebody would actually hollow out a building in Midtown Manhattan so as to put computers fraction of a second faster access to lower Manhattan. And because of the distance between upper Manhattan and lower Manhattan versus mid Manhattan and lower Manhattan,
right,
there was a distant advantage.
And this is like the speed of light that we're starting to try to jump in the middle of that stream.
Right.
I mean, this is not a long lag that they're trying to capitalize on.
Right. So you're looking at an advantage that is minuscule.
Right.
Try to get in front of that one. So with a combination of all of this stuff that I've been talking about, I know it's complicated and it's arcane, but here's the deal, is that when you look at all of this has one thing in common, and that is that information about companies, we're just getting better and faster information about all these companies, which makes the ability to outpace the market and find mispricings even more difficult. So hence, the whole idea of having anything choose your stocks, it might work for a short period of time. There may be mispricings, but as all of this becomes more common and more ubiquitous, you're not going to see those advantages.
Well, you mentioned this short period of time. This was one of the paragraphs that jumped out at me in that article. Is how did ChatGPT actually perform in a mock-up portfolio?
Yeah,
in an experiment of the financial comparison platform Finder.com, whatever that is. They built a portfolio of 38 stocks.
Right.
And in the 8-week period of this study,
what an eternity that
they
is.
had a 4.9% increase in the portfolio picked by ChatGPT.
Right.
The top 10 premier funds actually declined by 0.8%. The S&P was up 3%. So the magic 38 stocks beat the S&P by 1.9% in one study over an 8-week period.
Over a period of time where AI happened to be all in the news. And it was probably because maybe that AI actually chose more AI companies.
Yeah, it might have picked NVIDIA or something like that.
Exactly.
And so, 37, it'd be interesting to see the study. 37 of the stocks could have lost money.
Right.
And one stock hit it out of the park, and so they made 3.9%. But when we look at, getting the research to build an academically sound portfolio, we're looking at 64 years or more of data, sometimes 90 years of data. And I just cracked up. Well, in this 8-week period, it beat by 1%. Wow, that's really something you want to hang your hat on going forward with your American dream.
Big deal. And you look at this, and we talk about the computer systems, and it being a race to get computer systems nearer to lower Manhattan,
right?
In my example. There is going to be a race to have better AI, and all it will do is squeeze out those inefficiencies more and more, and that is the issue. You look at it, where do we see inefficiencies? Mostly in any kind of market. Real estate. Well, because you have a huge trading issue.
Right.
You have big commissions on buys and sells, number one, and then you have location. Everything is unique. And then you don't have as many buyers. The problem with the stock market is each one of these companies, each share, doesn't matter which share that you buy of Apple, it's going to be the same company that you're getting.
Right.
So it has become kind of a commoditized trade in a way. Whereas, when you look for inefficiencies, and that's what you're looking for is inefficiencies, you just don't see it. So it's a big waste of time.
Yeah. And it gets to the behavioral side, and at least they address that. In the article, it says the human instinct, the gut reaction to a sudden news flash, can a digital entity truly master this? Short answer is no, but humans can't master it either. You have to just not engage in that behavior. I think that's the appeal for this computer trading is, okay, I'll let the computer try to adjust to the news flash, but the computer shouldn't do anything either. A lot of times the right thing is to do nothing.
Yeah, it's a huge challenge. So anyway, don't let computers choose stocks for you. It's not ready for prime. And let me just make one last point before I go here, because remember, one of the things that we're looking for is we're looking for something that people will stick to. Remember, your behavior is going to be the biggest deal. Even if AI is actually driving the ship, that doesn't necessarily mean that you are going to stick with the program once it is set up.
Yeah.
So that can be a big problem as well. And then what ends up happening is and that's why I don't think that AI will necessarily pick portfolios that are well diversified, because a well diversified portfolio doesn't sell. If you look at, we've talked about this before, but computerized trading, and you look at robo-advisors and those types of things. And I use the example that the biggest robo-advisor portfolio out there would be the target date fund. And the reason that target date funds typically don't diversify well is because really well diversified portfolios just aren't intuitively as appealing, because they don't have the familiarity bias that investors crave and that they would stick with. We're more likely to stick with a portfolio that holds things that we're familiar with. And that's what the research bears out over and over again. So that it would be hard for me to see that where this would ever actually work because of human instincts and behavior. I think AI is going to be great in a lot of different areas. I remember that Elon Musk actually started a robotic portfolio back in the late 90s, and he abandoned it because of the reason I'm talking about.